Our next topic. There's an interesting article in the Wall Street Journal this week around Wall Street taking notice of what's happening at the regional banks. Austin, what's your take and what do investors need to know?
Yeah, I think that the point is these synthetic risk transfers, which is a fancy way of saying offsetting the risk from their loan portfolios to other investors is taking place. And one argument is this is happening to comply with some regulatory requirements that are changing. A pessimist, though, might look at it and say, hey, these banks didn't actually know what they were underwriting, and they're trying to offset that risk. It's more likely a combination of the two, but I think leaning towards the banks didn't really understand what they were underwriting because they're paying a pretty significant price to get these things off their books. They're actually paying hedge funds double-digit yields to insure against losses in their loan books, which does free up capital, but it puts a big dent in their income statement because they have to pay those double digit yields to go lend to other companies. So I think that there could be more risk to come. Another thing on the back end of that is there are the actual financing of the purchase risk transfer actually just spreads that risk out to other banks in the system. So if we were trying to improve the systemic risk embedded in these portfolios by offsetting the risk to hedge funds, it's not working because the hedge funds are just reaching out to other banks who are financing those pools, and you're just transferring that risk to other banks, which tend to be foreign banks.
Kind of smells like 2008 and 9. Adam, what's your take?
Yeah, I was about to say that, Jay. You read my mind. It's like not the first time that banks have looked at their balance sheets and gone, "Oh, whoopsie, what's this?" and then tried to find a bigger dummy, right? Like remember the leading up to the global financial crisis when a bank would look at its balance sheet and say, "What are all these weird mortgages? Oh, let's just package them up and sell them to Iceland." They can't read the fine print. It's dark 24 hours a day. Like it's the same story that just plays out again and again. And hopefully you'd hope people have gotten a little more savvy and a little more careful. But the reality is it's very tough from the outside looking in to look at a bank's balance sheet and understand what's there. They know, and we, the royal we, in terms of everyone else who's not in the bank, it doesn't know.
The most telling thing should be that JP Morgan did a transaction towards the end of last year to transfer $20 billion of risk off of their balance sheet to the balance sheet of others. Do you think if JP Morgan thought that all of those loans were money good, they'd be selling it to other parties at a double digit yield? Probably not. So I think people should remain somewhat skeptical. I think if we were to look out on the horizon and try to identify where there could be a problem in the market that causes the Fed to react aggressively, it's probably something linked to these portfolios, as many of the banks that know best are trying to get rid of them.
Yeah, if Jamie Dimon's going to give to charity, it's going to be the hair club for men so more people can be a sexy silver fox. It's not going to be just gifting other banks, assets that have a high return on investment.